So budgetary control is primarily a system where a company is implementing a cost budgetary control system. So this is where they prepare the budgets and they coordinate the budgets in accordance with the departments that are within the company, as well as establishing responsibilities for each of the divisions in the company. And the primary reason for understanding why a company implements a budget is to ensure that they have a sort of a strategy to compare actual performance with the budgeted performance. Now, why would a company want to understand why they are moving away from their budget? So can anybody tell me why a company would want to understand why they're moving away from their budget? Or what are they trying to determine when they're comparing the actual performance with their budgeted amounts? Now, if you're given a question in a tutorial, or you're given a question under an exam or a test, you might be asked questions such as, why do you think that a company should implement a budgetary control system? Why would a company want to understand what they are spending compared to what they've budgeted on? Can anybody come up with anything? You can type it in the chat box if you don't wish to unmute. Yes, there's a student that said they want to improve and maximize profits. Yes, that's correct. They want to reduce expenditure. But now let's drill down to, remember last week I said to you, move away from the textbook. So yes, you want to improve profits. You want to reduce expenditure, but how are you going to do it? Yes, you're going to see that your sales are not what you expected it to be, or it might be over that amount. You're going to see that your expenses are higher than what you thought it would be. What is it going to lead to? It's going to lead you to make decisions, correct? Yes, Kaylin, to manage and limit risks. Imperative when you understand budgetary control. It's to ensure that you, as a business owner, you understand what is the risk element, whether it is, and where is it structured within your business. Now, remember last week, now today's lecture isn't very long, but I want you to understand the components of budgetary control. Remember in last week's lecture, we went through the cash flows and we understood the operating, the investing, and the financing activities of a company. Within those components, we also understood specific elements in the income statement and the balance sheet. Yes, very good, Joy. To understand and concentrate on cash flows. Shanisa, that's an excellent point. It's to take where you are. Remember, you are moving profits to where you are making losses. So you're matching where there's a reduction in the expenditure to where there is a profit making. So all what you are saying and all what you're speaking about is decision making. It's primarily what are you going to do should you come to a point where you understand there's specific components within the company that is either making a profit or not. Now, before we go into the lecture, I want you to understand, and I spoke to you about this last week, time frames. Remember in the business plan, we said that we were going to include either draft financial statements or a budget, either quarterly, every 6 months, biannually, or every per annum. It's the same with budgetary control. You could have a system where you are budgeting on a daily basis, you're budgeting on a monthly basis, on a weekly basis. So what do we want to try and understand here? We want to understand what is called a master budget, what is a draft operational budget, what is a flexible budget, and what is a cash budget. So what we're saying is basically that we have a budget for each section of our business. So the master budget, by the very name, is the master budget. It's the overall budget of the business. The flexible budget is the budget where you have put in flexibility into components when you were drafting the budget. And a cash budget, by its very name, is what you intend on budgeting on a cash flow basis. So understanding first what the budgeting process is, we all know, even in our individual capacity as a student, we're budgeting what our income is going to be and what is our expenses going to be within a specific time frame, and what are we going to base it on? Specifically, what are we going to base it on? Now, for those of you who have listened to last week's lecture and who've attended last week's lecture, why have I highlighted past experience? Who can give me a very important point on basing any financial information on past experience, specifically in the current circumstances? For those of you who've listened to the recording of last week's lecture, what did I specifically bring about? What did I specifically emphasize? If you had to budget, you're now a startup business, you're a small to medium term enterprise, and you wanting to budget. So you've taken another company that you've worked at or you've worked within, and you basing it on their expenditure based on past experience. What is a primary element of basing any financial information on past experience? What does it mean for you as a business owner? Now remember, in ordinary circumstances of business trading, you would ordinarily undertake to either draft a set of financial statements or draft a budget based on what you thought the company previously had expended on. Isn't that correct? But now if you undertake a budget, how will you do a budget? So just remember now, I'm trying to understand and I'm trying to jog your mind, because I want you to understand that we're not in ordinary circumstances. Why aren't we in ordinary circumstances? Can somebody point out why aren't we in ordinary circumstances? Why aren't we in ordinary business trading circumstances? Yes. Yes. Now, because we are in a pandemic, how would you, as a business owner, try to understand how you should be budgeting? So say, for example, you have a startup business and you want to understand how to go about budgeting so that you do not get into a circumstance where you have underestimated your expenses and you've overstated income. What is key in undertaking a budget in extraordinary circumstances? What's key? How would you go about? Now, for those of you who have listened to last week's lecture, I mentioned the term scenario planning, and I mentioned the term sensitivity analysis. Has anybody heard of the terms before? When you scenario plan, for example, you expect to sell 100 units, and then you also in the same month, you scenario plan to sell 200 units. So what happens if you've got 3 budgets for 1 month, doesn't it make sense for you to then have sort of more than 1 budget in which you can rely on? Isn't this going to help you to monitor whichever situation you find yourself in? It's going to provide a bit of responsibility for the manager of the business to use that designated set of a budget to achieve that assigned operational objective. So the budget is going to be a tool that you're going to almost rely on to compare the costs and the benefits of the activity. And then you're going to be able to allocate the resources appropriately. It's fundamental that you as a business owner, that you are able to appraise the budget. Appraising the budget means you're able to measure the budget to your actual operating expenditure. Now, when we go into an operational budget, understand the term operation, it means your operations. So it means it's your sales. What is your sales driven by? Your sales are driven by the expenses as well as the income. Your sales are also driven by, and I've highlighted it for you here, it's the financial budget. And you notice that everything is derived in an operational budget. There's an interrelationship between operations and sales. So say, for example, in your budgeting for production, the 3 main factors of production, which you have learned probably from your undergrad or your tertiary education in economics, is materials, labor, and production, which is manufacturing overheads. So any company that wishes to undertake something, they will always incur materials. Materials means your raw materials, the inputs into your production line. Labor, you're always going to need a labor force in order to employ people. And manufacturing overheads means the rent that you pay for the premises, etc. So these all form now part of your cost of sales. Okay, somebody's put a note, Shanisa. Shanisa, excellent point. Businesses during the pandemic have started to pay attention to different business practices in order to accommodate customers. And certain companies have changed the way they are delivering goods and services to individuals. And we spoke about this last week. We said there was a significant shift from contact buying to online buying. So here again, when I go back to the introduction and I explained to you that primarily in an ordinary circumstance, you base all of this operational budget on any past experiences that the company has had. But you also need to understand that in order to mitigate, you don't know. Okay, has my slide changed? Somebody says we can only see the first slide.
No, it hasn't changed.
Okay. Okay, now can you see it?
Yes, we can.
Oh, thank you for that. Thank you, Banele. Thank you very much. So remember now okay, let me take you through the introduction. So remember we said that the introduction, I've highlighted past expenditures. So this is what I was looking at. So when I was speaking about the past expenditure, your textbook tells you that the budget is based on past experience, but it's relevant only to the fact that you are undertaking under ordinary circumstances. So I'm just trying to make you think a little bit out of the box with regards to the current situation in which we are faced in the pandemic. When we look at an operational budget, I said to you that it was made up of your production components, which is materials, labor, and overheads. So manufacturing overheads. I've also said to you, remember that you're working with 2 sets of financial statements. When you are working in a business, it's an income statement and a balance sheet. We know that an income statement, look at it very elementary, income statement, it means the income that you are making. So it's a profit or a loss. The balance sheet is specifically related to what's your assets and what's your liabilities. So when you're looking at an operational budget, I've divided it for you. So I've put a line across here. So you will then notice that we've only split it just between the income statement and the balance sheet. Why? Why are we looking at these? Because an income statement filters into the balance sheet. Now, when we look at a sales budget, we're still sticking with the operational budget. Now we're looking at what are the components of an operational budget. First and foremost, a sales budget. So if you look at your textbook, you look at the operational budget that's on page 235 of your textbook. It gives you a very illustrative example of what these components are within the operational budget. Now, I want to go through it with you. A sales budget. I've linked it for you. A sales budget is directly linked to the amount of inventory that you're holding. Am I correct? You can only sell what you've got in your warehouse. Hence, when you look at a sales budget, it's directly linked to whatever inventory that you're holding. Sales budget means, what do you expect to sell within a certain time frame for the company? The sales budget also includes, what aspects would a sales budget include? Would it include items where you don't necessarily have to only look at your item, but also what are the ways in which you are going to sell the product? So are you going to employ a marketing agent? And then that is going to form part of the sales and an administrative expenditure budget. So a sales budget is like a management's estimation of the sales for the future period. So a company uses the sales budget in order to set the goals and the expected forecast. And remember, point number 1 and point number 2 are directly interrelated. So the sales budget filters into the production budget. Why? Because you're going to produce what you expect to sell, because you don't want to overload the inventory budget and keep more than you actually need. Why? Why do you not want to do that? Why would a company not want to hold too much in their inventory, but rather meet their budget with production almost filtering into sales? Why would a company not want to hold too much in the inventory budget? It's self-explanatory. It's logical. A company won't want to hold in their warehouse a whole lot of products that they've produced. Remember, they've paid. If we go into the production, remember, they've paid for their manufacturing overheads, for the rent. They've paid the laborers. They've paid the person in that production facility. They've bought materials. So why would they want to hold something in inventory that they're not going to sell? Why would they want to now overload that inventory budget with items that are not going to translate into sales? Yes, it's a very good point that Seshlin has raised. When you hold inventory, there's a risk of theft and damage. Correct. Now we move on to the direct materials usage budget. Just want to see if, okay, I'm going to go into detail and explain to you. Nakubonga, excellent. To limit the costs that they might face. Yes, remember, you the business owner, you need to understand how to optimize. It's your job to ensure that that warehouse is not overstocked. So if you walk into macro, and if you understand even warehouses such as Game, or I will use macro as an example, you will always go through an aisle in macro where there is operational heisters. Now you notice in a warehouse type of a shop, such as macro, you as a customer, you walk in there, you've almost got to walk in sideways through an aisle. Why? Because there's a person that is real time, checking what is being sold on the shelf, and he's replenishing it from the top, from where the products are stocked on the top of the shelf, and he's bringing it back down. What is he doing? He's matching the sales to the inventory that's being held on the top shelf. Why? Because macro doesn't want to hold a whole lot of inventory in a warehouse. So you tell me now, using macro as an example, give me the reason why macro is holding that inventory above the shelf of where the customer can actually attain that goods. Why is macro doing that? Okay, Giselle, that's an excellent point. But I want another student, I want students to tell me why. For example, in a real life company, there's a company that's holding their inventory above the shelf in which the customer is actually using and obtaining those goods and services. So I'm going in to buy a pack of, say, for example, shampoo, and I'm buying a pack of 6. And immediately once I take that 6 off the shelf, there's a guy coming with a heister, and he's bringing down another box of 6 from the top down to the bottom. Yes, excellent. Now you're getting the point, students. It's a cost-saving mechanism. Why? Because they don't need to rent a warehouse. They don't need to now get a personnel, a warehouse manager, to get the warehouse now to supply the shelf, and which is going to incur extra costs. You're going to now rent another separate building, and you're also going to incur logistics. So what's more easier? It's more easier for them to have a warehouse and a sales operational capacity strategy all in one. So you need to understand how these separate budgets filter into each other. Do not think of them as compartmentalized. So you cannot think of it like a waffle. You know, when you go to the restaurant and you order a waffle, there's separate squares on each piece of that waffle that you are eating. You're going to think of it as a bowl of spaghetti. Now I'm giving you a very simple way of understanding it. This operational budget, everything is interlinked. So this is almost like a bowl of noodles. Everything is interlinked into each other. The direct materials usage budget, the very name, direct materials is something that you directly utilize in your company, production facility. The direct materials, for example, could be anything that you utilize in that production facility of whatever you're making. So if you're making cardboard boxes, you're going to use, for example, a piece of direct material would be recycled paper. Now, why would you want a usage budget? You want a usage budget because you want to understand how much of that recycled paper you're going to be utilizing in making those boxes. Am I correct? You want a direct materials purchases budget. Why? Because you want to know how much that recycled paper actually costs. And remember, the reason why we want a budget is because there's various suppliers of these direct materials. The usage budget. What is one key factor when a production facility is producing goods? What do they want to limit? So say you're in a production facility, and you're in a production facility that is making biscuits, for example. So you've got these mechanized machines that are doing the processes of making the biscuits, and then it's going into the oven or the kiln that is baking the biscuits, and then it's coming out into other machine mechanisms. Yes, exactly. Seshlin, you're on point. The reason why you want to understand what you're using is because you want to limit any losses. In other words, in-house built-in losses. What is that losses called? What is it normally called? If a company is, for example, got a machine that is, we'll stick with the biscuits, and they've got these biscuits that are coming out and they're being packaged but unfortunately the machine, there's something wrong with it, and it is, unfortunately, it's breaking the biscuits. So what is it called? Isn't it called wastage? Yes. It's called Nokobile. I hope I'm pronouncing your name correctly. If not, you are on point. It's wastage. And when you have a wastage system, it is, you need to understand, in order to mitigate this here, there's something called a byproduct. So say, for example, you've got those biscuits that you cannot package. You can obviously probably repackage it in a simpler packaging and sell it as a byproduct. Now, moving on to the purchases budget, I've said to you, you ideally want to understand what you're purchasing. You've also got your direct labor budget. So here with the labor, you want to understand your employment of the people that you are employing. Now, why would you want to understand the direct labor budget? So say, for example, you've got load shedding. Yes, Minehle. You've brought an excellent point up. It's sunk costs. Now, sunk costs are costs that have diminished and you're unable to resuscitate any of those costs. So let's move on to direct labor. So say, for example, you've got load shedding and you've got a certain number of employees that are semi-skilled employees, and they're dependent on the machinery. How are you going to assess? And what's the implication? Now, remember I said to you earlier, I spoke a very specific point earlier, in order to mitigate the changes in what we are going through at a specific and extraordinary circumstances, what you're going to implement. So if, for example, you've got a labor force and you've budgeted for them to work an 8-hour shift, and now you've got load shedding, which means that they've got to work after hours, and then they've got to now attain that amount that you've budgeted. So they've lost 4 hours in load shedding, and they've got to work at night. What's the implication of that? What's the implication of employing people in your workforce? Who can think of what is the regulation? What are we regulated by? What is each employee regulated by? So you've got to go now to, yes, it's labor laws. Now, in your labor budget, if, for example, you've predetermined there's load shedding, you now understand that the 4 hours that the semi-skilled workers would have undertaken in their normal time, they've now got to work at night, which means that it's overtime. Correct. It's not by consequence that they have implicated that load shedding. So if you now had to scenario plan, you've now got to understand that you're now going to be paying an extra amount for that labor, or even make it up on a weekend. And in a weekend, the labor laws say that you have to, what does labor law say? Does anybody know? What is the total number of hours that anybody can work in a working week? It's 40 hours a week. Anything above 40 hours accounts for extra time or overtime or double time. So these are the things you need to take into account when you're doing each of these budgets. A manufacturing overheads budget. Overheads means everything over and above anything that is direct. So it's not directly consequential. So it's not a direct material. It's not a direct labor. Okay, Shanisa, that's a very good point you've got with regards to generators. However, in order to now think a little bit more there, Shanisa, in order to invest in the generator, what would they have had to do? So actually, this question says to every bit of student here, you've got something that you can mitigate it with. So you've got a generator here. So that there's no labor hours lost. But what does a generator mean? Doesn't it mean CapEx? Doesn't it mean capital expenditure? Doesn't it mean funds that you need? And doesn't that mean budget? Anything that you expend in a company, it has to come from somewhere. So at some point, in order to mitigate any loss in the usage or any loss in the purchases, any loss or anything that you're not making a profit, you have to understand it has to come from somewhere. And here, when I say budget, you must remember last week we spoke of investors in a business plan. So it has to come from somewhere. When we look at the manufacturing overheads budget, what we mean is anything over and above what we directly inputting into the manufacturing process. So it's overheads. Overheads mean something like rent. So rent for your warehouse. So remember, I'm just using the current circumstances to make you understand that there's many ways in which a company can either make a profit or a company can make a loss. So remember, you've got warehouses you're an essential service during lockdown 5. You can make use of that. In other words, that manufacturing, the rent, for example, that you're paying for your warehouse, it's fine because you're an essential service. You're in the medical industry and you can pay it. But what if you were in the manufacturing process, but you were not an essential service? So you were producing luxury teas and coffees for only hotels. Now, you know, in lockdown 5, travel and leisure was the hardest hit. What's going to happen here? Wouldn't that then mean that you would have made a loss? Here again, bring in the aspect of scenario planning and sensitivity analysis. Sales and admin budget, here again, directly related to your sales commission, to any marketing expenditure, administration. Are you going to hire an accountant? Are you going to hire an external HR manager? So ideally, the operational budget is a budget that's preparing you for a specific department. It could be a specific cost center as well. So the difference here between specific department and specific cost center, it's not necessarily two different things. Some companies, they like to plan their budgets per department, and some companies call it a cost center. So in other words, the HR department is called a cost center. The admin department is called a cost center. Some companies want to split that HR department. They want to say, okay, salaries fall under HR. So salaries is one department. Then there's a person that's doing the admin work, so they are doing the postage, they're doing the secretarial work. So under that HR department, there's an admin department. So specific departments are also called cost centers. Why? Because companies want to measure at every single point of transaction, whether what is being expended and what are they expending and what's the income that's coming in. So all operating budgets are then combined. So what we're saying here, all this operational budgets, all here become the master budget, which includes a budgeted statement of profit and loss. All this means is that it's an income statement and a comprehensive income, and the statement of financial position. All it's saying here is that it's the income statement and the balance sheet. So the master budget in entirety means that it is the income statement and the balance sheet, as well as the statement of changes in equity. Now we moved on to a flexed budget. So a flexible budget is anything that's allowed or that helps a company to allow for costs at different levels to be changed. So let's take, for example, the manufacturing industry. They want to know what's going to happen if I increase my production facility to maybe produce a little bit more, so 250 units as opposed to 200 units. So when we talk about a flexible budget, all we're talking about is a flexibility or an adjustment in anything. Why? Because we want to understand and correspond it to a specific activity level within the company. So a flexible budget then requires you to understand the intricacies of your costs. So in other words, if you go into the expenditure part of it, you want to understand every single cost component. So say we moved from 200 units to 250 units. We want to make sure that 50 more units that we are making, what is going to be the total cost for that 50 more units with regards to the variable costs, with regards to the fixed costs, with regards to any cost that we can control, costs that we cannot control. So the flexible budget is normally, it's a very useful tool that can compare your actual costs to your budgeted costs. But I'm going to use this in an example. So if you remember, there was a company that was in the industry of frozen foods. So it used to be called Rainbow Chicken. Now, they used to employ a flexible budgeting system because they wanted to understand. Now, remember, their production process started off right from and I'm taking you back now, They started off right from the input process. So what did rainbow chickens mean? It meant that they had livestock. It meant that they had that product that they were selling right from the onset of the actual chicken, the actual egg, and then they moved on to supplying it to the end product, which is the frozen foods. So now, why did Rainbow Chicken want to understand what's the flexible budget of theirs? Why did they want to understand? Because every single day, there were components within their company, within their costing structure that was changing. Now, remember, within the poultry division of theirs that they had poultry that they actually stocked within that department or that structure in their farms. Now, they had no control over the fact that a certain chicken was going to be able to live, or that piece of poultry, or that department, or that almost that, how can I say it, that pen of poultry in pen A is going to live for, say, for example, 3 weeks. So I'm going to take it down, drill it right down to the floor. So you would then have a person that's going in and checking how much of poultry they have each day. And do you know what? There's never a day that went past where they had 5 chicken, and in the next day they had 5. There was always a game changer. There was always either more because they would lay eggs, or they were less because somewhere down the line, there was poultry that just never, some died. So they were never, ever able to get an income statement where they had a fixed amount of income and a fixed amount of expenses. So they then invested in a flexible budgeting, where they would then go into an assumption basis based on however many and however much they were spending, and what was the intake of the poultry, what was the sale of the poultry. So then they invested in a flexible budgeting system where they then understood, okay, fine, if we had 5, if we had 10, if we had 15 inputs, this is what our outputs were going to be. But what was the downfall of that? It was very expensive to implement. Why? Because you needed manpower. You needed to drill down into every single bit of cost activity. You needed a person on the floor 24/7. You needed a rotation of shifts of employees. You needed employees who were willing to go out into outsource farms. And if you understand the dimensions of Rainbow, you will understand that they've now closed some of their plants. They've closed some of their agricultural and their farming businesses, because they drill down into their flexible budgeting to such an extent that they were actually making a loss. They were making less sales than what they were expending on managing their costs. So if you look at the illustrative example on page 242, you will notice that they provide you with a very intricate example of a flexible budget. But when we talk about flexible budget, all you need to understand is an expansion. It's an expansion of a business. So you almost like a laser beam, where you're the starting point, and that beam is across your business, and you want to understand every single bit of component of cost behavior. How do your costs behave? When we talk about cost behavior, what are we talking about? We talk about what is the level of, for example, wages that's going to be required should my production change to a certain level. Cost behavior. How does one affect the other? So when you look at flexible budgets, please just remember that analogy. We now move on to cash budgets. Cash budgets, remember I said to you in last week's lecture, cash is king. Cash means that you can readily have this money available. So cash budgets, they help a company anticipate the future cash needs, which is an extreme importance for cash management. A major reason is because of business failure. I've spoken to you about this last week. I said to you, please keep abreast of what's happening in financial news. The budget translates all the other budgets into cash terms. So for example, the sales budget, the direct labor budget, it all needs to transform into a cash budget. And the cash budget also shows you a pattern of the inflows versus the outflows. The cash budget also helps you highlight whether you're going to have any potential difficulties. And now, who can tell me that it's going to highlight potential difficulties? What is it going to help you to do? So it says here specifically that if you're given an exceptionally tight period, you will be able to seek alternative finance. That's 100% correct. But in budgeting, now remember, in month 3 or 4, you've realized you're going to be making a loss. You're going to have to seek an alternative finance. Now, who can tell me something very important? I've spoken to you earlier on in the lecture. Who can tell me something very important? How are you going to mitigate? So how are you going to actually bridge the gap between your tight finance and seeking alternative finance? How are you going to bridge that gap? So you own a company, you know in month 3 you're going to be in trouble. You know that you need to now go to a financial institute. How are you going to bridge that gap? Who can give me an example? Who can tell me what you might think of to bridge that gap between having no cash inflows or no cash resources and seeking alternative finance? What can you do? So what can you do? Can you tell me what you can do? Yes, Shanisa, you can apply for a loan. But when you go to your finance institute, or you're going to go to any person where you're going to acquire that finance. Yes, Seshlin, thank you for bringing last week's lecture into perspective. You're going to draft a business plan for external investors, but think a little bit more. Just think a little bit more along the lines of how are you going to sell it to the finance institute? How are you going to sell it? You're going to take your application, you're going to go to the finance institute. Am I right? But how are you going to convince them to give you the finance? Okay, we're almost towards the end of the lecture, so you can just put it out there. Just think of ways in which you can maybe try and sell your plan. Seshlin, how are you going to sell your business plan? Yes, Giselle, you're going to show your plan for the months after you receive the money. But what are you going to do in order to receive that money? You all have the right idea. You know that you're going to have to go seek the finance. You know that you're going to need a business plan. You know that you're going to have to sell it to them to say that, look, I'm going to actually be receiving the money. But how are you going to receive the money? My question to you is, what's going to be your strategy to show an investor that you're in a tight position? But listen, you can still invest in my company.